All right, so Wall Street has the Magnificent Seven, but what about the burger drive-through dynasty? No doubt about it, I think Americans love cheeseburgers, and I'm trying to figure out which burger chain is the best of the best. I'm not just going to rely on taste alone because that's way too subjective. So in order to figure that out, some of you might just look at the company's stock price chart and be like, ooh, it's $10 now, and it used to be $50. Maybe that means it's a good company, it's undervalued, and assume that it's good to go. This is not financial advice, but you really shouldn't be doing that. That's how you end up losing a lot of money, and that goes into the realm of gambling your money and treating the stock market like it's a casino. There's a way to do it. There's a science in order to minimize your losses and to make sure that the company that you are eyeballing is truly good or not. For me, I like to look at the numbers and financials because it helps us to assess whether or not we have a beauty in our hands. And that's why in this video, we're going to be comparing all of the different burger stocks that are publicly traded here in the US. Actually, I live in Japan, but I say here in the US because I'm an American, against one another with the metrics that I think are relevant to see which ones on paper have the cheesiest, greasiest, and most delicious burgers. If that sounds good to you, then let's go ahead and get into it. The first hamburger chain that we're going to be taking a look at is Wendy's, ticker symbol WEN. And by the way, if you're new here, nice to meet you. My name is Amos, and I do in fact shower naked because I have sweaty nipples, especially in the summertime. In Japan, it gets really hot and humid. I've been living here for 3 years, and it just gets hotter every single year. But anyways, Wendy's, their market cap right now is $2 billion. So when I think about their size in the stock market, are they a big fish or a little fish? Well, this is categorized as a mid-cap company. $2 billion to $10 billion mid-sized. So they're neither big or small. And after looking at Wendy's 10K and their annual report, this is how I would sum it up. They're asset light and they operate with a franchise-heavy business model, meaning they do not operate the restaurants themselves. In fact, globally, about 95% of all the Wendy's are owned and operated by franchisees, according to their 10K. So how does Wendy's, the company, make money if they're not the ones running the show? Well, through the franchise fees, rent, royalties, and licensing fees. So whatever the franchisees make in gross profit or gross revenue, they usually have to give like 4, 6, or even like 9% of that to Wendy's HQ. And what's really interesting about Wendy's is, as of today, in June of 2025, they are the second largest burger fast food company based on foot traffic and dollar share, which kind of took me by surprise because I assumed it would be Burger King, but Wendy's is actually number 2. And right now they're currently trading for about $11.46. Their 1-year metric, what's the lowest price that they reached in the past 365 days? We're talking about $10.98. So since then, they rebounded by 4%. Needless to say, they're pretty much at their lowest price point right now, if I were to buy into them. And their revenue, is it growing year over year? And by the way, I'm going to do it by the percentage change year over year because some of them post billions of dollars and other ones post millions of dollars. But because of the size of the company itself, their market cap and their operation size, I feel like that gross number is not a good way to compare apples to apples. Rather, I think the percentage change year over year is a more effective way to measure their financial success through their operations. If you agree with me, let's continue. But anyways, their revenue grew by 2% year over year, which I think is not bad considering most restaurants are actually struggling really hard right now. To grow 2%, pretty good. And as we take a look at their dividend profile, you might be salivating and your wife is probably like, honey, what's wrong with you? Because you see a 4.9% dividend yield. Yes, I rounded up. Please don't be that wise ass. That's like, excuse me, sir, it's actually 4.8.9. No. Let's just round up, keep it simple, all right? KISS, keep it simple, stupid. That's one of the best and first advices that I received as a young lieutenant in the Army, and it served me well. Don't overcomplicate things. So 4.9% dividend yield, and you might be like, dude, that's pretty darn juicy. And I would agree with you, except when you think about their dividend history, dude, it's rough. because their annual dividend payout right now is 56 cents. Yes. However, is it growing? No, it's not growing. And as a matter of fact, the reason why I put not available for their dividend growth rate is because they just cut their dividend payment by 44%. So the dividend yield prior to that cut, I think the yield was like almost 8%. And it dropped down to just shy of 5%. But now they are categorized and defined as a dividend cutter. And if you are a friend of this YouTube channel, then you know how much I hate dividend cutters. Because once they cut that dividend, if they run into any more speed bumps in the next 12 months, 36 months, they are going to cut the dividend again. And I've seen this time and time again with companies that go down this slippery slope. But anyways, is the dividend sustainable after cutting the dividend? Well, that is the good news. Yes, it is sustainable because the earnings per share essentially tells us the profitability, the net income, the bottom line per share outstanding. So when you think about it, 94 cents, right? Of that, 56 cents will be paid out to the shareholders as dividends, which means they still have some cash left over in order to reinvest into the company, in order to increase the dividend for the next season, to do share buybacks, or to pay down their leverage and their loans. So having excess EPS is a good thing, because that pans out as the dividend payout ratio. For instance, if the EPS for Wendy's was 56 cents and their dividend payout is 56 cents, then the dividend payout ratio would be 100%, meaning it has to be cut. That is not sustainable. Okay, but to see 94 cents, I think now they're in the territory of where the dividend is going to be okay, but it still hurts my feelings to know that they cut the dividend. Anyways, the next metric is going to be the return on invested capital, the ROIC. Through their CapEx, what is the return on investment? What is the profits they make from the CapEx that they spend? Because what I'm trying to tell you is if a company is going to spend like $5 million in order to modernize or improve or to scale their distribution output, is it going to generate profits, or is that going to be a loss leader, or is that going to continue to burn cash for the company? Okay, I see it happen with a lot of startups, but for most mature companies, usually if they have like 10 distribution centers and they open up one more to be 11 distribution centers total, it usually helps the bottom line and their overall supply chain empire. So to see a 5.8%, not bad. Now, in the context of the burger stocks, I would say anything below 5% is going to be a red flag or not good, or they're really aggressively trying to scale their operations. So we want to see a number between 5 to 10% to be like a green light, be like not bad, good, average. Anything above 10%, and that's where I say, hey, that's pretty good. That's pretty juicy, pretty delicious. And if it's in that, 15% or above category, then they're crushing it. Like, you don't understand. To see an ROIC of above 15% is really darn impressive. And on that note, I want to give props where props is due, because for the past 20 years, on average, Wendy's ROIC was 4.2%. So today, to see it just shy of 6% means that overall, in the grand scheme of time and things, it is growing in the right direction, up and to the right. So that's good. However, at a 5.8%, nothing to write home about. It's kind of like seeing a 2% dividend yield. It's decent, but it's not juicy, if that makes sense. So to see like an ROIC of at least like a 15%, that's kind of like the equivalent of a dividend yield being like a 4%. So their dividend yield is good, but remember, keep in mind that they did cut the dividend. And their free cash flow per share situation right now is $1.20. However, the year prior, it used to be $1.27, which means it went down by negative 2.4%. And again, instead of looking at just the overall free cash flow situation, I'm looking at the percentage change year over year and on a share level. That way, it's easier for us to compare the large cap burger companies to that of the micro and the small cap burger companies. And that's why whenever you are in doubt, always break it down to the per share level. Look at the EPS. Look at the dividends per share. Look at the free cash flow per share. That way you can compare that to another stock in your portfolio or to a benchmark, such as like an S&P 500 ETF like VU or SPY. And I think their free cash flow per share going down is one of the variables as to why they had to cut the dividend, because I think they were able to afford it, but I think their company is operating with safety in mind, because you don't want to pay too much of your EPS, your net income, your bottom line out as dividends. You do want some cash left over. And so I see why they did it on a business level, but from a shareholder or potential investor's perspective, that's disgusting. That's ugly. All right. So for me, I don't really like to go near companies that cut their dividend. And the last metric that we're going to apply across all the different burger companies absolutely going to be subjective, and I call it the burger experience score. And it's going to be a number ranging from 0 all the way up to 100. And it's based on the following factors. Number 1, the visual test. Whenever I walk by, drive by, or see this burger restaurant, do I see a line of cars or people in their drive-thru, in their lobby? Does the business look well maintained? Is it clean? Is it dirty? Etc. And then the second factor is the crave factor, meaning, could I potentially eat there every day? Do I crave them late at night? If I'm pregnant, is this what I want 24/7? Or on a road trip, is that the kind of place that I'm willing to drive out of the way so that I can eat at? Like, say there's something, 5 minutes down the road, but I really want to go here and it's 20 minutes out of my way. Will I make that trip? And does their menu innovate? Do they implement seasonality items? And last but not least, I don't want to just put my input into it. I am going to incorporate the voice of the people. And I found this poll made by Food and Wine, where essentially they analyzed and looked at over 119,000 Yelp reviews for all of the various burger chains in America, and they ranked them all the way from first place down to 25th place. I will say this though, almost every single Chipotle, McDonald's, KFC, like those big name brands, they usually have like a 2-star rating because people love to complain. Because from my understanding of humans and our psychology and behavior is that when things go well, we usually don't leave a review. When things go bad, we tend to be very vocal, angry, and we leave a 1-star review while being in a very emotional state. So that means based on the Yelp reviews, something went wrong. Like you ordered a chicken sandwich, but they ended up giving you a beef patty burger, something like that. Or you asked for no pickles and they gave you extra pickles. And that's why you ended up giving it a 1-star. But anyways, based on the Yelp reviews, Wendy's is actually ranked number 22 out of 25 burger chains. That's pretty darn bad. But from my personal experience, I'm gonna say this. This might be unpopular, but I'm not a fan of their burgers. It's just something about the beef patty, it just tastes off. It's like a little dry and it doesn't taste right. And I know their motto is always fresh, never frozen, but I don't know, man. The burgers itself just does not taste very good. And the funny thing is, my grandma used to live across the street from a Wendy's, and almost like 2 to 4 times a week, she would go there just to get their chili. I'm not joking with you, she was the biggest fan of their chili. But for me, I tried it once as a kid and then once again as an adult. Just does not taste right to me. Similar to how I feel about their burgers. I know we're starting out this video with a negative opinion, and I'm sorry if I offended you, because for someone out here, they're probably very mad right now because you're like, dude, how dare you hate on Wendy's? It's my favorite burger chain, but we still have 8 more to go. Okay, there's 9 total. It's just not my thing. I'm more of a clam chowder kind of guy, so not into their chili. And in terms of their burger, I don't want to give it away of what I prefer, but I will say this about Wendy's. Their breakfast menu biscuit sandwiches, dude, out of this world, so freaking good. And dare I even say, I think out of like the burger chains, I think Wendy's breakfast menu might be one of the best. I know that's a bold statement to make, but this is not a breakfast menu breakdown, right? This is the cheeseburger breakdown. So When I think about everything, how I feel towards Wendy's, how I'm not really a fan of their taste, their quality, and the fact that they're almost ranked dead last according to Yelp reviews, that's why I gave them a 60. However, overall, as a grade, I think this is a company that is struggling right now and will continue to struggle, as evidenced by the leadership to preemptively and prematurely decide to cut the dividend. That means they know something that we don't, and they're forecasting speed bumps coming their way. And so, for me, I think Wendy's is a solid D+. I'm not even going to say they're an average type of company. I think they just missed the mark of being average. They're slightly below average, but they're not hideous. They're not disgusting. They're not gross. But it's definitely a company that I wouldn't want to go near. So if you're invested into Wendy's, I'm really sorry, dude. But as we move along in this video, maybe you'll see another burger company that might interest you because their financial health and their operations look better. I don't know. Not financial advice, but on paper, I think Wendy's, no bueno. So the next burger chain that we're going to be talking about is Jack in the Box. Ticker symbol Jack. About 93% of all of the Jack in the Box locations are operated and owned by franchisees that send a fat check to headquarters. So what they are doing is very similar to Wendy's. But anyways, ticker symbol Jack. And their market cap is $400 million. This is a very small company. And they're currently trading for about 21 bucks a share. Their absolute bottom price for the past 1 year is $18. And since then, they're up by 18%. So they've rebounded pretty well, I would say. Is their revenue growing year over year, their top line? This is really important, right? And it's a no. It shrank by -6%. But the crazy thing is, it does get worse. Because as we look at and assess their dividend profile, you might be like, dude, an 8% dividend yield, sign me up, take all of my money. And to that, I say you might want to hold your nipples. Because even though the dividend yield is 8% and the annual dividend payout is $1.76, what you have to know is that the dividend is not growing. And as a matter of fact, it has not grown or increased since May of 2021. So for the past 5 years, it has just stayed rock stable at 44 cents a quarter or every 90 days. But the thing is, this dividend is not sustainable. How do I know this? Because their earnings per share is negative $10.88. That is really bad. That means they're not making any profits. Their bottom line is in the red, is negative. So how in the world are they able to afford a dividend? They're using loans. They're using leverage. They're using debt. That is so freaking bad. So not only is their revenue decreasing year over year, but their dividend is absolutely not sustainable. And their bottom line, their profits, in the red, they're in the negatives. They're losing so much money, and they're financing the dividend payments to the shareholders through loans instead of free cash flow or the cash that's on the books. And I almost feel bad for Jack in the Box because it gets even worse. Because right now their ROIC is 7.7%. And actually, that's pretty darn decent. However, when you take a look at their historical trends and average, it's around 8.7% for the past 20 years. So it's slowly going down in the wrong direction. And I think what's really repulsive and disgusting and just hideous about Jack in the Box is their free cash flow situation. Right now, it's $1.71. I'm actually very surprised that they have positive free cash flow. However, a year ago, it used to be $6.75 of free cash flow. So you're telling me that their free cash flow per share situation, they went down by 74%. Dude, that's really bad. So on paper, operations, their data and their financials, really freaking bad. Jack in the Box, I don't know what's going on. Because when I used to live in California, now I'm talking about the Amos burger experience factor. When I used to live in California, I went to a Jack in the Box 7 or 9 times when I was first settling into my apartment. I didn't really feel like venturing out because I was super stressed with everything that was going on. And there was a Jack in the Box across the street. So that's where I ate for the first 2 weeks as I was settling in. And it was always a pretty good experience. At least it was, 8, 9 years ago. And even back then, I gotta give them credit because their mobile app had really good deals. Like you buy a sandwich and you get a large fries for free, or you buy chicken nuggets and you get a free drink, stuff like that. Unlike here in Japan, dude, this is one of the things I hate about Japan. There's no such thing as like a good deal or discounts. In Japan, I am not exaggerating. If you go to a McDonald's or whatever their fast food chains, Sukiya or Yoshinoya, their deals are usually for 5 pennies off, 5 cents off. And they think that's good. From an American culture and perspective, I'm used to getting like buy one, get one half off, or buy one, get one free, or even in a country like South Korea, there's always something called a service, right? If you buy 2 of these, we'll give you 2 for free. If you buy 1 of these, you'll get 1 gift for free. In Japan, that kind of culture and mentality just does not exist. But anyways, this is not a video about my experience living in Japan. But other than the deals and the food tasting good for Jack in the Box, I will say this. That location that I went to, I don't know if it's just specific to California, SoCal, but it was very dirty and run down. The restaurant lobby looked like horrific. It looked like someone vomited all over the floors. It smelled like a bag of poop. And I wouldn't be surprised if during the night shift there was a bunch of cockroaches running around. I know what I just said sounds pretty harsh, but remember, I think their burgers themselves really freaking good. It's that good, juicy, greasy, flavorful type of burger that I like. But I still think it's gonna be overall a 70. So that's the experience score. And of course, before I forget, according to the Yelp analysis, Jack in the Box actually ranked pretty darn decently at 11 out of 25. I would argue that's not bad. They're just outside of the top 10. And so a score of 70, but I don't think that's enough to save them from their horrific, atrocious financials. So overall as a grade, I think Jack in the Box is a very solid D-. And I think what's saving Jack in the Box from receiving that F tier, that's the worst possible grade that you can get, is because they are actually free cash flow positive and their ROIC is not bad. But I'm telling you right now, if their ROIC was trash and they were free cash flow negative, then they would belong in the F tier. And believe me, there are going to be some F tier burger companies coming up. So don't click away. Keep watching. The next burger company is going to be Shake Shack. Ticker symbol Shake. Now, their business operations are a little different from the first 2 burger companies because it's kind of a mix. It's a hybrid model. Not only do they have company-operated restaurants, but they also have franchised ones as well. And according to their 10K, here's how it breaks down. Almost every single Shake Shack here in the US is company-owned, minus a few dozen or so. And almost every Shake Shack that operates internationally, like in Asia or Europe, is licensed to a franchisee. So let's kind of break it down and distinguish what's the difference between being a company operated and owned restaurant versus the franchise model. So in a very simplified manner, there's more nuances and details than this, but with franchising, you only usually earn royalty fees, right? Like a cut of like 4 or like 9% of the gross sales plus rent if you own the land or the property and you rent it back out to the franchisee. However, with company-owned stores, you earn 100% of the store's sales. So your gross revenue is going to be a lot higher, but so is your associated costs to operate your business. So Shake Shack is inherently going to have lower margins, but their overall dollar situation, especially in the next like 20 or 30 years, is going to be a lot higher than Wendy's or Jack in the Box if Shake Shack continues to be a company that's publicly traded and is still afloat. And another advantage of operating as a company-owned restaurant is that there's better quality control because you're not going to have an independent or a decentralized franchisee doing political statements and ruining your business model in the Middle East. Like that genuinely happened to McDonald's and Starbucks. But I guess in the case of Shake Shack, that wouldn't really apply because all of their locations overseas are operated by franchisees. So, but at least in the US, they have better control of just focusing on the business operations rather than becoming a political statement type of business and ruining your economic moat tied to the brand loyalty factor. I'm talking to you, Target. Why are you trying to play both sides of the aisle? Like, Oh, it hurts. It hurts to see. But anyways, let's take a look at Shake Shack's numbers. Their market cap is $5.3 billion. So it's a good medium-sized company in the stock market. And it's funny because even though they're newer, they're bigger than Jack in the Box and Wendy's, especially in popularity and valuation. And their current trading price is $124 a share, which is pretty crazy. Because I remember during the stock market sell-off when almost everything was deep into the red back in March and April, their lowest price in the one-year metric is $72. If you bought into Shake Shack when they hit that valley bottom price, first of all, you're a genie in a bottle because how did you calculate the bottom price? And number two, you'd be a happy boy because you're up by 70% since that bottom 52-week low price. That's pretty crazy. For a $5 billion company to have a volatility swing like that is pretty wild. And their revenue is growing year over year at a rate of 14%, which is pretty crazy. If you back up and you look at 5 years ago, it used to grow at a rate of like triple digits, but it's now slowing down and it's more manageable. I have a number in the teens range, like a 12% to like an 18% revenue growth year over year. And unfortunately for Shake Shack, they are newer, so they do not have a dividend profile. A dividend profile is usually associated with companies that are mature enough in their operations and in their cash flow that they can finance and forecast to keep paying a dividend in the next 5, 10, 20, 40, 50 years. But for Shake Shack, what's happening is they are aggressively scaling and growing their business operations to the point where they don't really have cash left over to afford to pay a dividend. So for me, it's a slight blemish, but it does make sense as to why there is no dividend from a quote-unquote growth company. So moving right on down, they do have earnings per share, which means they are profitable, 31 cents EPS. Which means if they really wanted to, they could pay a dividend of like 4 pennies per year, 1 penny every 90 days, if they wanted to. But all that to say, I am relieved to see that they are profitable and they do have some cash left over when taking into account their bottom line. And when we take a look at their ROIC, remember how I talked about earlier, if you have more company-owned stores than the franchising business model, you're gonna have a lot more operational costs and deductions and overhead payments. That's why their ROIC, not as good, a 1.8%, because they have to spend their money to deal with all of the various operational expenses. So in the context of Shake Shack, they use their CapEx to build, improve, and maintain the physical restaurants, to train, to hire the staff, and everything in between. The seats that you sit on, the grill counter, the aprons that they wear, everything costs money. But I think what's going to happen in the future is once they become more mature and established, I think they're going to start selling all of their company-owned restaurants to franchisees. I think right now they want to have better quality control and to only open up shop where they know it's going to succeed instead of just trying to expand as fast as they can and then having some locations fail. Because I would argue almost every single one of their locations are killing it. So even though their margins are pretty trash right now because they are a growth company like Cava or Chipotle, I think in the near future, like in the next like 10 years, once they start franchising out everything, I think their margin situation will get a lot better. So their ROIC is going to bump up to like a 5 or 10%. But as of right now, it is a 1.8%. And when we take into account their free cash flow per share, right now it's 90 cents. However, what you want to keep in mind is last year it was 81 cents. And that's why we're seeing a growth rate of 11% year over year. Now, what's really wild about Shake Shack is it's only recently that they became profitable. Because up until 2024, they were free cash flow negative, earnings per share negative, and just burning through cash. However, as of recently, they are generating cash that's left over to put into their pockets to do share buybacks or to expand quicker or to do whatever they want with excess money. It is a good thing to see a company have excess free cash flow. And moving on to the very subjective burger experience score, I'll tell you this right now. On Yelp, they're number 3 out of 25. It's pretty darn impressive. And it makes sense because I'll be honest with you, I've tried Shake Shack multiple times in different countries and the burgers taste good. Don't get me wrong on that end. However, I think for what it is, it just costs too much. I think it reminds me of Five Guys. I grew up in Northern Virginia, and I used to go to the first opened Five Guys before they became like this huge burger chain. And it used to be like $4.99 for a burger. And then if you got the fries with it, it used to be like $2.99. They would fill up an entire brown paper bag with fries. However, I went to a Five Guys like 3 years ago, and now it's like almost $18 for burger and fries. Like, that's absolutely ridiculous and ludicrous. And that's kind of like how I feel about Shake Shack. I think their burgers just cost a little too much for what it is. It's small. Like, the burgers aren't even big. It's not even a deluxe or a premium burger. We're talking about smaller than my fist, and I have pretty small hands. It's not big. And I think at that price point, if I'm going to be paying like $15 or $12 for a burger and fries, dude, I would rather just go to a Whataburger down in Texas, Oklahoma, that area, or Freddy's. Dude, Freddy's steak burgers, so freaking good. I bet most of you have never heard of them. And here's the crazy thing. When I used to be a model and I did all of that acting nonsense, I actually had a sponsorship deal with Freddy's. It's just I couldn't sign with them because I had like a conflicting schedule and I didn't have time to meet with them. So Freddy's will always have a place in my heart. I like them. And if I want to save a little money, but not on the taste experience, then I would rather go to In-N-Out than a Shake Shack. However, I can't deny that whenever I do walk by a Shake Shack, there's a line of at least 10 people. And when I look inside the lobby, it's like completely packed. So from a visual standpoint, I think their business is crushing it. It reminds me a lot of like Chipotle. Whenever I go by a Chipotle, especially during, the lunch hours of 11 to like 2, completely packed. Dinner time, even worse. One time I had to stop at a Chipotle in Boulder, Colorado, and dude, it was no less than 100 people, and the line was moving so freaking slow, but I was willing to stand in that line with all the other people. Like, Chipotle's business model and their hype and the value of food, of what you get for what you pay, can't be matched. But anyways, this is not a video about Chipotle. And thinking about Shake Shack, when I used to live in Korea, I actually remember when the first Shake Shack was opened up there in Seoul, and the line to get in was so freaking crazy. I remember the Koreans were willing to wait in line for like 5, 6, 7 hours just to try and taste the Shake Shack burger. Now, I'm going to say this right now. That's a pretty crazy marketing team that Shake Shack has got going on, because you have people willing to wait half a day in order to try your burger. By the way, my dogs are barking like crazy.
2 hours later.
Sorry about that. My wife came home for lunch, surprised all of us. The dogs were super excited. But anyways, getting back to the video, Shake Shack. So overall, as a grade, is it going to offend you? Are you going to be triggered if I say that Shake Shack overall? I think it's a B. They're above average. They're not in that A tier because they just started to become profitable. And their metrics, kind of weak for now, right? The ROIC 1.8%, EPS 31 cents. And more importantly, they do not pay a dividend just yet. However, on the other side of the argument, as a growth story, I believe in them. So if I were to just believe in their story and speculation more so than the data and financials that I see on paper right now, they would be an A tier, no doubt in my mind. However, what I'm trying to say is if they can execute the numbers that they're pulling off, it's in terms of like their revenue growing 14% year over year and their free cash flow per share growth year over year for the next 5 years, then I would be a believer and they would be in the A tier. But remember, this is just the first year of them being profitable. Who knows what's going to happen in 2026? Or for the rest of this year. So a B for now. I think that's more than fair. The next burger company is going to be Restaurant Brands International, ticker symbol QSR. Dude, that is so clever and witty. Because QSR is quick service restaurants, which is the burger joints and the space that they operate in. You'll have to see it. And their business model, about 99.7%, almost safe to say 100% of all the Burger Kings are operated by franchisees. So QSR does not get their hands dirty. They only do the high-level marketing, HR, finance, forecasting, and whatnot. It's the franchisees that are running this show. And where are my manners? Let me post their numbers right here. Ticker symbol QSR. Their market cap is $31 billion. So out of all the companies we have looked at so far, it is the biggest company. $31 billion, that's really big. I mean, it's not to the levels of like Amazon, Tesla, Apple, Microsoft, but it's not supposed to be, right? This is the drive-through dynasty. This ain't the Mag 7. But anyways, currently trading for about $69 a share, and their 52-week low, $58. Since then, they're up by 18%, almost very identical to Jack in the Box. And their revenue growth, now this is where it gets really crazy, because it is growing at a rate of 22% year over year. That's very aggressive, and I have to say, I am impressed. I did not expect that from Restaurant Brands International. By the way, this is the parent company of Popeyes, Tim Hortons, Firehouse Subs, and Burger King. It's not just Burger King. And as we jump down to take a look at their dividend profile, dividend yield is 3.5%. That is juicy. So remember, the golden standard is 3% and above for qualified dividend-paying companies. And the annual dividend payout is $2.48. That's relevant because we're going to compare that to the EPS, which is $2.95. Tells us that the dividend is sustainable and it's growing at a rate of 6% year over year. So unlike Shake Shack, unlike Jack in the Box, unlike Wendy's, their dividend is actually growing. That's huge for me. And as we take a look at their ROIC, currently it is 9.3%, whereas historically for the past 10 years, on average, it's 7.9%. So they're improving their operations and the return on investment for their CapEx. This is really good. I like what I see so far for QSR. And when we think about their free cash flow per share, as of right now, it is $2.87. Last year, it used to be $2.64. So it's a growth of 8.7% year over year. These are pretty stellar numbers across the board. As we jump down to take a look at the Amos Burger Experience score, why is it a 20? So here's my confession. Growing up, Burger King used to be magical. You know, in the 90s here in the US, it was good. It tasted phenomenal. However, in the past 7 years, I tried to recreate that experience I had in my youth. And every single time that I visited Burger King, it doesn't matter if it was in California, Oklahoma, North Carolina, Georgia, Virginia, it doesn't matter where, I have not had a pleasant experience. It doesn't matter the location or the state, or if it's busy or if it's empty, it tastes like a bag of ass. I don't know what is going on. I don't know if they changed the recipe or how they do stuff, the methodology of how they prepare their char-grilled burgers, but something's going on. It doesn't taste right. And I think that's a shame, because I'm not afraid or scared to admit that one of my most favorite foods in the world is a cheeseburger, but Burger King just ain't it. And I say that because some people are like, oh, Americans, you have no culture, you have no good food. And it's like, dude, what do you know about mac and cheese? What do you know about cheeseburgers? What do you know about the American style pizza? What do you know about the soul food down in the South? Or the way that the Chinese make their food, American Chinese. Oh my gosh. Have you tried authentic Chinese food? Doesn't taste good. But the American style Chinese food tastes so freaking good. At least it does for my palate. And then of course we have a huge barbecue culture, right? Every single time there's an NFL big event or someone in your family is graduating from this or that, we have a cookout. Dude, barbecue ribs, steaks, oh my gosh. Don't tell me that Americans do not have good food. So cheeseburgers, I think, belongs in that conversation, and maybe I'm basic, maybe I'm ugly, maybe I'm stupid, but I think cheeseburgers are pretty darn good. I could probably eat one right now. But anyways, I give it a score of a 20, which might be diabolical because in the Yelp reviews analysis, they are ranked number 19 out of 25. So they're not considered the ugliest. I think that's reserved for, what is that, Steak and Shake. I've never been there, but to be rated dead last, that's pretty impressive. On the other hand, I feel like I'm being a little harsh because every time I do go by a Burger King, it's not empty. They do seem to have customers. And so I think we should bump up their score a little bit to maybe 21. Going from 20 to 21 makes no difference. But anyways, that's subjective. And I'm not taking that into account for their overall grade. I think that one is just for fun, right? The Amos Burger Experience metric. But overall, as a grade, I think QSR, now this might be weird, but I think it's a B. I think it's a very solid business and a stock. So if you invest into QSR, I can't hate on you. I think it makes absolute sense as to why someone would invest into them. Their numbers make sense. But I think what's preventing them from jumping up to the A tier is that none of the numbers are actually in that crazy territory, except maybe the revenue growth. But other than that, everything is just decent. It's above average, but it's decent. And I think in the QSR portfolio, I don't think it's Burger King that's executing and pulling off these numbers. Between you and me, I probably think it's Popeyes that's doing all the heavy lifting, and Burger King is just there for the ride and enjoying the consequences. But still, they're part of the same family, so we'll give it to them. The next burger company that we're going to be talking about is Red Robin. And when we think about their business operation, it's mostly company-owned restaurants. They don't really do the franchise business model. I think according to their 10K, about 10% are franchised. The other 90% are company-operated. And unlike the other companies that we talked about here today, Red Robin is not the kind of establishment where you go through a drive-through or it's like really fast. Red Robin is the kind of place that you go to kick it back with your family or friends to watch a game, and you sit and then you eat and you conversate for like an hour and a half, like a pretty long time. It's not supposed to be quick. So it's a regular, traditional sit-down restaurant environment where afterwards you tip your server, all of that. Ticker symbol RRGB. Their market cap right now, $100 million, and I think, yes, they are the smallest company that we are talking about here today. That's a micro cap company. That's really small. They're currently trading for about $6.40. Their 1 year metric, the lowest price is $2.50. What I want to call out is, since then, it's gone up by 156%. So based off their market cap and 1 year metric, the stock price is absolutely volatile. And that's why, personally, we all have preferences, right? Some people like to shower with other men. Some people like to wear their shoes inside of the house. Dude, I've never understood that. Whenever I went over to my friend's house and they would just keep their shoes on and climb into bed or onto the couch, dude, you walk outside, you step on the most dirtiest surfaces, and you'll bring that into your home. And because for me and our family, what we like to do is to put on our home clothes. We don't wear our outdoor clothes indoors. I don't know, maybe it's like a germaphobe thing. But anyways, all that to say, there are people that prefer different things. For me, I like large cap companies because it reduces that volatility and the swings of the prices going up or down in a crazy manner. Like, can you imagine if you invested into Red Robin and the price went down by like 90% in one day? And for the next day, for it to just go back up by 50%. Those are the swings that you can experience when the shares outstanding and the float and your market cap are all small. That's why with big companies like Apple, even if they have a really good day, it's hard for them to really move the scale. It'll go up by like 3 or 4% because it's like $1 trillion market cap. And for me and my risk tolerance, I prefer that. But I'm not really married to that strategy because I kind of prefer something in the middle. Like if they have a really good day, I would rather want to see a stock go up by like 15 or 20%, you know, somewhere in the middle rather than going up by like 90%, but also the potential to go down by like 100%. Something in the middle is my cup of tea. But anyways, small cap, very volatile. And when we think about their revenue situation, dude, went down by negative 4% year over year. And this is where it's going to get really freaking ugly. Because as we take a look at their dividend profile, I filled in the blank with not available. Fact of the matter is, Red Robin used to pay a very fat dividend. That was quite juicy, but ever since 2020, they've been struggling. Once that pandemic hit, I think the smoke and the mirrors, they were removed, and we really got to see Red Robin for who they were on their financial statements, and they just can't catch a break. So their dividend profile is no more. They slashed it and then eventually just got rid of it altogether. And you already know how that makes me feel. I don't like it. And I think it makes a lot of sense as to why the dividend had to go. Because as we take a look at their earnings per share situation, it is a negative, just like Jack in the Box, $4.93 in the red. And you might be like, dude, when does the pain end? Well, not yet. Because as we take a look at their ROIC, it is also trash. It is negative 2.6%. Dude, that is so freaking bad. That means for every investment that they make into building out a new restaurant or to replace aging equipment or everything, they're losing more money than they do in making profits from those improvements. That's so freaking bad. The ROIC past 20 years on average is 3.8%. Now it's negative 2.6%. This is so freaking bad. However, you might be like, Amos, I think you're speaking way too harsh because their free cash flow per share growth is 62%. Yes, at first glance, it looks amazing, right? Until you find out that it went from negative $3.19 to negative $1.21 year over year. So in the grand scheme of things, their free cash flow is still negative. And that's why the dividend really had to go. Not only is their bottom line non-existent, but they don't have any free cash. It's all going into the red. And before I really started to look at Red Robin as a stock and as a business, it kind of took me back. I didn't really expect that from Red Robin because I remember growing up in the 90s, Red Robin used to be all the rage. Every kid wanted to have their birthday there, right? Red Robin, yum. Like their sex appeal and marketing was so great, phenomenal, fantastic. But something happened like in the late 20-teens, like 2018, 2019, where they just lost it. Like nobody resonates with Red Robin anymore. So me personally, I would give them the burger experience a score of like an 80. I really enjoyed Red Robin. And here's where I want to prove my point that it does not matter how high of a score I give them for the burger experience because that does not neglect the fact that their financials, metrics, and their numbers are it's really freaking bad. And on this channel, I try not to give Fs on any stocks because I truly feel terrible for the people who are potentially invested into that stock and for me to trash on it, bag on it, to make fun of it and be like, oh, this is terrible. Because that would be a really bad feeling, right? It's like if I had 10 grand invested into Red Robin, for instance, and then this idiot on YouTube is like, oh, it's an F tier. Dude, I would feel upset too. However, just understand that the numbers don't lie. It's not me trying to be malicious or trying to ruin your day. I think objectively on paper, this is an F tier investment. And I don't know why, but it kind of pains me to say that because I feel like it's such a shame that Red Robin's business operations and stock is just not as good as the eating there restaurant experience. Dude, if you've never been to a Red Robin's before, then they have this thing where it's called the bottomless fries. So no matter what burger that you order on the menu, it's usually like $8, $9, or $10. It comes with bottomless fries. Meaning, if you finish your fries in the basket that they give you, you could just ask your waiter for more. It just keeps on coming. There's no limit. And not only that, I actually felt like their burgers tasted pretty darn good. It had good flavor, good substance, good size to it. Like when you hold it, it's quite girthy and just quite juicy. Okay, you're sick. Get your head out of the gutters. And it's something that my wife and I used to enjoy a lot when we lived back in the States. But yeah, this is just one of those things where it's like a great product or a great service, but a terrible stock and investment because the management team is just not, I don't know what they're doing, but they are not driving this ship in a proper manner. So friends and family, we have our first F of the day, and that is going to be Red Robin. And the next burger joint that we're going to be talking about is Fat Brands. Now, this is the parent company of a whole boatload of different restaurants. But relevant for this video is going to be Fat Burger, Elevation Burger, and Johnny Rockets. And their ticker symbol is FAT, which I think is pretty funny. And this is straight from their 10K. This is how they describe themselves. We operate primarily as a franchisor of restaurants, where we generally do not own or operate the restaurant locations, but rather we generate revenue by charging the franchisees an initial franchise fee. It's usually like $50,000 to $100,000 to open up a branch or a restaurant, and then they also generate revenue from ongoing royalty fees. Now, this asset-light franchisor business model provides us with the opportunity for strong profit margins and attractive free cash flow. Keep that sentence in mind. That's what they boast about and why they do the franchise model, but will they execute on it? I guess we'll see. And it goes on to say, we choose to do this because we can minimize the restaurant operating risks, such as long-term real estate commitments or capital investments. For some of our brands, we also directly own and operate restaurant locations in addition to franchising restaurants. So when I took a look at their portfolio, the numbers, this is how it pans out. About 80% of the Fat Brands restaurants are operated by the franchisees, and the other 20% are company owned. So ticker symbol FAT, their market cap is $50 million. That just might be the smallest market cap I've ever seen in a stock in the stock market. $50 million. Dude, that is tiny. And each share of Fat Brands will set you back about $2.81. Their one-year metric is $2. Since then, it's up by 39%. And when it comes to their revenue, it grew by 23% year over year. And once I took a closer inspection and look, I think because of their portfolio mix and acquisition strategy of swallowing up the next big restaurant chain, their revenue is pretty darn good. And it's been growing aggressively since 2021. So the gross sales and the amount of money that they're able to generate in the big picture view is pretty good. But are the operations efficient? Are the margins there? Are they profitable? Are they actually free cash flow positive? Let's move on. Their dividend profile. Right now, the dividend yield is 9.9%, just shy of 10%. But for the dividend growth rate, I put down 0%. And that's because they have not paid a dividend since November of 2024. And up until that point, the growth rate was also non-existent. They were not growing the dividend. And then going into 2025, they just decided to pause paying out dividends to the shareholders. And based on what I see and what you see on screen right now, I don't think they're going to be paying a dividend anytime soon. And I think in the near future, they're going to have to officially cut the dividend. What I just said is further evidenced by their earnings per share, negative $11.95. That is pretty darn bad. And what makes this even worse is that since 2020, their EPS has been negative. So you're telling me that their bottom line, their profits, negative for the past 5 years? Well, that's exactly what I'm telling you. But it gets worse. Because the ROIC is negative 0.37%. And the historical ROIC, also not good. So I think what's happening here is, I think the restaurants are successful and they're able to generate aggressive revenues for the company in a bigger picture scenario. But on an execution level and in the details, they're just not doing the right moves or the right calls. I've never worked for Fat Brands and I don't know what's going on behind the scenes, but I'm guessing it has to do with their inventory, their supply chain, their employee turnover costs. Because think about it, right? Say you only need to buy like 1,000 buns for a particular day, but like a manager just miscalculates and keeps ordering 2,000 buns. What's going to happen? That means almost every single day they're going to have to throw away 1,000 buns. By the end of the week, that's going to accumulate to 7,000 buns being thrown away. And that money is just being eaten up and affects the profit margins of the company as a whole. I don't know. That's one variable. And I think that's one thing that might be happening. And you might be like, dude, pump the brakes. Because when I see their free cash flow situation, it looks pretty good. Well, until you learn the fact that it's going from negative $4.64 to negative $3.73. Keyword here being negative. And I'm going to be completely transparent with you. I've never had a burger at Fat Burger or Elevation Burger, but I did hear that Elevation Burger is pretty good. However, I did experience Johnny Rockets a handful of times. And if you're not familiar, Johnny Rockets is a sit-down dining establishment that serves burgers, and they try to recreate the whole 1950s vibe and atmosphere. If you're into that kind of thing, the good times, that's Johnny Rockets in a nutshell. And I'll tell you this. Every single time that I had to go, it wasn't because I wanted to. It's like my group of friends or a colleague or whoever wanted to go, and I was just kind of reluctantly saying, okay, let's go. Because the burger itself is nothing to write home about. It's pretty average. You know what I'm saying? It's kind of dull. It's kind of boring. There's nothing that's like stands out. It's just your standard normal burger. I would compare it to Fuddruckers, but Fuddruckers at least has substance and flavor. Johnny Rockets doesn't really have flavor. And I know this is very subjective. However, recently I did visit the States and I went to 2 different malls in 2 different states that both had a Johnny Rockets in their food court. And I'm going to tell you this right now. Both occasions relatively empty. And the sad thing is, every restaurant near them and around them absolutely packed and crowded with people. But they still didn't want to eat at Johnny Rockets. I think that says something. And even I didn't want to eat there. You know, it's one of those places where I never crave. It's never like, honey, we should go to Johnny Rockets. That like literally has never occurred in my life. Although I will say this, in Seattle, dude, at one point I was super hungry because we were walking like 10 miles a day, just doing tourist things. And even then, I didn't want Johnny Rockets. We chose to eat at Dick's. By the way, if you're in the Seattle area, go to Dick's Burgers. Great value, good price. Although the weird thing is they charge you for the mustard. It's like 5 pennies. The ketchup is like an additional 5 pennies. They charge you for every little thing. If you don't really like the accessories and the condiments, you get a bare bones burger at a very bargain price. So Dick's Burgers in Seattle's phenomenal. And to add salt to injury, in the Yelp analysis review, they don't even have Johnny Rockets in the top 25. Dude, that's really sad. And by the way, Red Robin, 10 out of 25. So for fat brands and the burger experience, I'm gonna give a 40. And so when it comes time to giving them a grade, I think based on their numbers, I think we can tell, right? We've learned that fat brands is just not a well-managed company. I think at the ground level, they have a lot of issues across the board with their margins, generating cash, and with the operations itself. Now, please don't call me evil. Please don't call me racist. But I think this is an absolute dumpster fire of a stock. There's nothing attractive about them. Okay, the revenue is attractive, but it doesn't matter if the margins and everything else is just hideous. So ultimately, as a grade, I think they're going to be in the F tier alongside Red Robin, which is pretty surprising to say the least. Because I think it goes to show that even though the burger market might be saturated, it does not mean that everyone is going to succeed. As you can see, right? Like only 2 of them are in the B tier, and there's 4 of them that are slightly below average right here, and definitely terrible investments over here. So it is kind of fascinating. That's why I like doing these videos, right? Because when you look at a sector as a whole, you quickly get to see that not all of them are worthy of being in your portfolio. Now, if you are invested into fat brands, please correct me. Like, what is the value add and the investment thesis for this company? Because based on my reading of their 10K and annual report, I was not impressed. Now, the next company that we're going to be talking about is Yum Brands. This is the parent company of KFC, Pizza Hut, Taco Bell, and Habit Grill and Burger. This is the parent company of a burger joint, and that's why they're a part of this list. And what's interesting about Yum Brands, oh my gosh, it's 1:25. I've been filming for like an hour and 50 minutes now, but anyways, what's interesting about Yum Brands is for Taco Bell, KFC, Pizza Hut, it's almost strictly franchise business model. But for Habit, Burger, and Grill, it's about 85% company owned, which means they're gonna have a bigger burden with operational costs. So anyways, where are my manners? Let me go ahead and post them right here. Ticker symbol, Yum. Their market cap is $39 billion, so it's a really big company in the stock market, and their stock price is 143. 1 year metric, we see 122. Since then, it's up by 17%. And their revenue, is it growing year over year? Yes, friends and family, at a double-digit rate. Pretty darn impressive to say the least. And as we jump down to take a look at their dividend profile, just shy of a 2% dividend yield, just missed the market being decent, but we'll give it to them because the growth rate of the dividend, which is $2.84, is pretty good. They're growing it at a rate of 8.2% year over year. For earnings per share, it tells us that this number right here that's coming out of this number, very sustainable. A lot more room for growth. Even if they stay stagnant at $5.06 as their EPS for the next year or two, this still has the potential to grow to like $2.93 to almost $3 in dividends and still be in the green and be okay. And as we take a look at their ROIC, it is a 14.8%. I'm going to repeat, a 14.8%. That is absolutely bonkers. That is really good. They just missed the mark of that really special category of 15% or above, but 14.8% is still pretty good. However, what you do want to keep in mind is that for the past 20 years, on average, their ROIC was 18.2%. So it is declining, but it is still impressive overall. And their free cash flow per share situation, right now it is $5.11. Year over year, it increased by 1.6% because it used to be $5.03. And as we think about the burger experience, I'll say this. When I used to live in California, I think In-N-Out was my go-to. Like that was my favorite burger joint. But if you know anything about In-N-Out, it is popular for a good reason. I think it's really similar to Dick's Burgers in Seattle, where it has a cult following because the bang for your buck is just almost perfect. Dick's and In-N-Out. However, when the line was too long for In-N-Out, my backup would be Habit Burger and Grill. You go there, there's never a line, although there were always people eating inside the lobby. And I'm gonna say this, I think the Habit Grill Burger is almost perfect. The ratio of ingredients, the condiments, the juiciness, the flavor, it's quite attractive. And what's really interesting about Habit Burger and Grill is before Yum Brands decided to acquire them, they used to be on my watch list because I was such a fan of their food. I started to look into their financials 7 years ago and I was like, well, this is actually a pretty darn good company. But then once Yum Brands acquired them, I kind of backed off because I was not in love with Yum Brands 7 years ago. So I'm gonna give a shout out to whoever it was in Yum Brands that was like, hey, we really do need to acquire Habit Burger and Grill because they killed it. That was the correct move. So in terms of an experience score, I'm gonna go ahead and say a 90. That's how highly I think of Habit Burger and Grill. If you've never tried it, but you live near one, try it out. It's that good. And in terms of a grade, I think this is a very solid B+ tier of a burger company. I think, honestly, they could have been A- if their ROIC did not drop from their 20-year average. But still, when we take into account their dividend growth rate of 8% year over year, the ROIC still being at least 15%, and the financial health of the company itself, it's all pretty attractive. So I think we do need to make a minor adjustment. Because if Yum Brands is a B+, I think it's really unfair that QSR is only a B. So I think because their free cash flow growth is 8.7% year over year, revenue growth 22%, I think we're gonna have to bump them up. And you know what? That's okay. Sometimes in life, you make mistakes, you own up to it, and you make the necessary adjustments, and you move on. So I think QSR, we're gonna go ahead and say B+ as well. I think it's pretty darn good. Even though I'm not a fan of Burger King itself, QSR as a business and Yum Brands as a business are both pretty solid. And the next burger company, commonly known for the Golden Arches, also running on the franchising business model. And to elaborate on that, because the franchisees run all the stores and McDonald's avoids the operational headaches, McDonald's is considered asset light. They do have a lot of ownership assets in that they own a lot of land and property, and what they do is they rent it back out to the franchisees to collect rent from them alongside with the royalty checks and licensing fee checks and whatever gross sales checks from the franchisees. Ticker symbol MCD, and about 95% of their restaurants are operated and owned by the franchisees. Currently trading for about $300 a share, their market cap is $217 billion. Dang, that is huge. So based off of market cap alone, McDonald's is probably one of the top 50 biggest companies in the world. And when we take a look at their 1 year metric, 243, if you snagged shares of McDonald's at 243, you did a really good job. Because I remember I made a deep dive video for them not too long ago, and I was actually picking up shares when they dropped below 260 because they were way below their inherent worth. But anyways, since then, they bounced back by 25%. McDonald's is one of those companies that rarely goes on a dip. So whenever I have the opportunity to buy McDonald's on the dip or Domino's Pizza, I usually end up buying a share or two, because I think really highly of them, understanding their operations and their numbers, and they're both considered favorites and darlings in the stock market. So to pick them up on the dip on a discount, for me, no-brainer. But that's for me. That's not financial advice. Is their revenue growing year over year? Yes, it is, friends and family, at a very sluggish pace because McDonald's unfortunately was involved with boycott movements, with people protesting against them and everything. And I think it did hurt their bottom line. And one thing that I don't really like about McDonald's is they're trying to rebrand themselves right now to becoming more of a premium burger establishment and trying to let go of what made them famous and so popular, which is being that place where you can get something for $1. Their dollar menu today is good enough to get you like a packet of ketchup. But to defend McDonald's, they are trying to pivot into and push hard into the drinks category with their cosmic cafes. And that's huge margins. So I wish they would go back to their roots of being like that bargain burger place, because I don't think anybody who grew up in the 90s or early 2000s associates McDonald's as kind of like a Shake Shack competitor. Okay, McDonald's, they need to learn their territory and stay in their lane. It's like someone with a Honda Civic, revving their engine next to a Tesla at a red light saying, race me, unless it's like completely modded out. But if it's a stock like 110 horsepower with like 90 feet of torque, they're going to lose, right? Because the Tesla, I think it goes like 0 to 60 in like 4 seconds, maybe even faster than that. They got to stay in their lane. Right, if it's like a Honda Civic versus like a Toyota Corolla, that's a fair race. But a Honda Civic trying to go into the lanes of like the Teslas and the Bugattis and the Ferraris, it's like, McDonald's, come on guys, go back to being the bargain burger place with an affordable menu. But anyways, I don't want to go on that rant. And as we take a look at their dividend profile, 2.3%, it's a decent dividend yield. Payout is $7 per share. Pretty good. Growth rate, for a company as big and as old as McDonald's, it's growing at a pretty sweet rate of 6.9%. Don't you just love that number? 6 and a 9? Anyways, just shy of 7%. And as we take a look at their earnings per share, $11.39, it tells us that this number, absolutely affordable, and you love to see it. On the other hand, if their dividend payout was $7.08 and this number was $7.10, I would be waving the flag because that's a payout ratio of like 99.99%. And when it comes to their ROIC, this is really freaking impressive. 16.8%. Dude, that is bonkers. That's in the territory of like elite levels of ROIC for a burger establishment. 16.8%. Just before I go on a tangent, is it the best? It is the best one that we saw here today. That is really freaking good. And here's the thing. It's not like it just happens overnight. For the past 20 years, their ROIC on average is 16.1%. So it's slowly going up in the right trend, and it's always been 16% or better. I think there was like an anomaly year where it did drop a little bit, but they always find a way to rebound and be back up there to that 16% ballpark range. And that's really freaking good. And as we take a look at their free cash flow situation, it's going from $9.24 to $9.31. Tiniest growth, but they are in the green by 0.8%. And time to talk about the burger experience. So according to the Yelp poll and survey and analysis of the reviews, McDonald's is ranked 17 out of 25. And I can't say that I disagree with the people because I eat at McDonald's about twice a week here in Japan. And when I used to live in the States, I used to hit up my local McDonald's at least once a week. And that's even before I became a shareholder. I think that's because like McDonald's is one of those places where you crave late at night. McDonald's is just one of those places where it just always seems to taste good. I think they have that taste, quality standardized across the board so that it doesn't matter if you have a cheeseburger in New York or in Philadelphia or even in Atlanta, it's going to taste the same. That taste that you want. Like when it comes to Burger King, it's all over the place. Sometimes it tastes like ass and sometimes it tastes just below average. But I never had a delicious experience with Burger King in the last 7 years. And don't even get me started on their fries because I think it's the best in the industry. And that's something else going against Burger King. Their fries suck. They're large, those wedges is about the same size of a McDonald's small in terms of the fries. Just not good value, not good bang for your buck. And even though I do like the taste of McDonald's burgers, I'm gonna say this. I am pretty annoyed by the fact that the beef patty size has just been shrinking year over year. It just seems to get thinner and thinner and the circle just keeps getting smaller. But something cool about McDonald's is that they're never scared to innovate or bring something new to the menu. And I really like the collabs that they do. And the Happy Meals, absolutely iconic. So I think for the burger experience, I'm gonna go ahead and say 75. It's not the greatest thing in the world, but it's far from being the worst. I don't think McDonald's should always have a perpetual 1-star rating. Like if you pull up McDonald's on Google Maps or on Yelp, I don't know why. It doesn't matter where you live. Every McDonald's around the country has like a 1 or 1.5 star review out of 5 stars. It's a tragedy, but whatever. Subjective. But to stay objective, when I think about McDonald's on paper and what they're doing and their size in the industry, ultimately, I think McDonald's is an A-. I know, what I just said right there might be a scandal because no, they don't have the highest dividend yield or the highest revenue growth, but when you take into account their ROIC being super consistent, stable, and really good territory, plus their dividend growth rate of 6.9% for this big of a large cap company, and their consistency, for me, that's what gives them permission to be in that A tier. Now, because they are going through some headwinds and some scandals and some setbacks, I can't wholeheartedly say that it's an A+ or just a flat out A. By the way, if you're not used to the American grading system, an A is pretty darn good. It's like almost at the top of the spectrum. An S tier would be like, oh, golden poop. A tier, pretty impressive. So A minus, B plus territory for McDonald's. Now, with that said, do I think McDonald's is good value at about $300 a share? No, I don't think so. At $300, I think they're fairly valued. I think $325 and $330 should be like their price target range, but going from $304 to $325, there's not much upside, right? But there's a lot more downside and risk associated with them going back down to like $275 or $260 even, right? However, for me personally, I think if McDonald's reaches the territory of like $265, $260, or even $250 a share, for me, that's my price point to dollar cost average. So A minus. I mean, is it any surprise? The YouTube channel name is what? Dividend Compounders with Cheese. So you already know that I like McDonald's. I'm a shareholder of McDonald's. And to see them be crushing it for this long, for as long as they've been in the game, to be at the top level for that long, dude, I think that's all intangibles that we are not taking into account. Because between you and me, I think being the biggest dog in any industry is a good thing, because that means you have economies of scale, you have brand recognition, and more touch points with the consumers. Because, for instance, if you're driving home from work, why drive 20 miles out of the way to go to a Five Guys if you know there's a McDonald's right across the street from where you live or from where you are right now, proximity? McDonald's scale is just something that I really like. All that to say, if their revenue was in fact declining year over year, and their dividend growth rate was like 2%, and their earnings per share was a lot closer to the number of dividends paid out per share, then I would drop them down to like a B minus or even C plus. But as it stands right now, even if their numbers are not bonkers, I think they're still in the A minus caliber. Do you agree? Do you disagree? Let me know. And moving on to the last company, this one is going to surprise most of you. And that's going to be Texas Roadhouse. Now, they're mostly known for their steaks, but their burgers go crazy. That's my go-to order whenever I go to Texas Roadhouse because I think it tastes so freaking good. I think they use the ground beef from their steak meats that are about to go bad. And so consequently, it's just that much more juicier. Whereas every other burger joint uses like the lowest quality beef, Texas Roadhouse has to use the steaks that are about to go bad somehow, right? To maintain their profit margin and operating costs. And so when that turns into a grounded hamburger patty, dude, so freaking good. Likewise, my number 2 go-to order is chopped steak. It's basically ground beef, a little bit of mushrooms, a little bit of onions. So freaking good. Ticker symbol TXRH. And Texas Roadhouse operates on a hybrid model. About 80% of their steakhouse, burger joints are company owned, 80%. And then 20% are franchised. And as of right now, Texas Roadhouse is $194 a share. And taking into account their 1-year metric, they're up by 30%. Is their revenue growing? Boy, is their revenue growing. Almost every single year for the past 4 or 5 years, growing at a double-digit rate. Similar to Shake Shack, right? I think Texas Roadhouse is 15%. What was Shake Shack at? 14%. Very similar business profile in my opinion. And when we take a look at their dividend profile, you might be like a 1.4% dividend yield and dismiss them, but stop, okay? Because check out their dividend growth rate, 11.2%. So this number right here, $2.72, is growing at a rate of 11% year over year. Friends and family, that is really impressive. But is it sustainable? Is it healthy? Yes, the EPS is $6.51. So the payout ratio is really small. They can keep growing and sustaining this dividend for time to come. And when we take a look at their ROIC, dude, I cannot believe there's a restaurant that is better than McDonald's in this category. 17%. You gotta be freaking kidding me. A 17% ROIC. Now here's why it's even crazier. In the past 20 years, on average, their ROIC is 11.9%, which means slowly with due time, it is going up to the right, in the right direction. You love to see it, just like McDonald's. And their free cash flow per share situation is just wild. It's going from $3.25 to $5.96. That's an increase of 83% year over year. And I'm gonna say this right now, no matter the occasion, no matter the hour, no matter the location, I've never had a bad experience at Texas Roadhouse. When we talk about the synonym butter dinner rolls that they get for free at the basket, and you can get unlimited refills on that, by the way, when we talk about the free Veterans Day meal, you bet your ass I'm going to be at a Texas Roadhouse. Not Applebee's, I'm going to be at a Texas Roadhouse. The customer service, the atmosphere, the taste of the food, and the overall affordability of the menu. Like if you take your family of 4 or family of however many people are in your family to a Texas Roadhouse, it's not going to kill your wallet. It's good bang for your buck. So when I think about the burger experience and my personal take and opinion of Texas Roadhouse, I think it's going to be a 99. And I know some of you might be confused, like, why are they 99? Why not just give them 1 full point and make it 100? It's because one time I did feel a little fancy. I was feeling myself and I ordered the prime rib instead of my usual go-tos, right? The burger and the chopped steak. And dude, it was so disgusting. It tasted like a moppy piece of bread. No flavor, and it was just oozing blood everywhere. Like, dude, I like my steaks medium. I'm not the kind of freak to get a steak well done. I'm not. But my prime rib, like no matter how much I was cutting it, it wouldn't cut because it was literally just a chunk of flesh. And don't even get me started on how many times I had to chew just to swallow. It was a horrific experience. I do not get the prime rib at Texas Roadhouse. And that's their only blemish, right? So I give them a 99. But in terms of a grade, I think this is where everyone is going to agree. Their numbers speak for themselves because friends and family, there aren't many companies in the stock market that qualify to be in the S tier. Honestly, it's probably less than like 150, maybe like 125 out of the entire stock market that are truly an S tier company. And that's what I think Texas Roadhouse is. In my personal opinion, they're everything that McDonald's is in terms of like their pros and their benefits, plus more. Because when you take a look at their ROIC, 17% to that of 16.8. When you think about their free cash flow per share growth, 83% to that of 0.8%. The list goes on and on and on. The growth rate right there. Obviously, the yield is a little bit higher with McDonald's, but the growth rate is almost double. The revenue growth is just bonkers. There's too much to like about this company. Now, overall, in the spirit of transparency, out of this entire list, I am invested into McDonald's and Texas Roadhouse. Those are the 2 companies that are in my portfolio, so I feel like maybe I'm being a little biased. This is me correcting myself. I don't know if truly McDonald's can be an A- because now that I compare them to an S tier, being 1 tier below but having these numbers, I feel like McDonald's belongs in the same category as Yum Brands and as QSR. I think this is going to have to be a B+, because I think what's holding them back is their free cash flow and their revenue situation. I think it's unacceptable that it's around a 1% growth rate year over year, but that doesn't take away from the fact that they're still a behemoth, that they have a huge economic moat and brand loyalty across the social economic classes. It doesn't matter if you're rich or poor. Like even Warren Buffett eats at McDonald's breakfast menu every single day through the drive-thru. I don't know if he does anymore because he's in his mid-90s, but I'm sure he gets it DoorDash, the Berkshire Hathaway. But even if you're poor, rich, ugly, handsome, a college student, or a working professional, I think everybody likes McDonald's. So I think that's an intangible that I take highly into account. But I think B+ is fair. So let's take a look at how it all pans out. This is the final picture. So my question to you is, do you agree? Do you disagree? How do you feel about the grades? Now, as you think about what you want to say and you type it out, I want to talk about a few things before I sign out of here. If you're wondering why I'm wearing a Korea jersey instead of my Seattle Sounders one, it's because we recently played Vancouver Whitecaps, and dude, it was a belt-to-ass performance. They just smashed us. I will say this, though. I think the ref, dude, what were they doing? They gave 2 red cards to the Sounders, so effectively it was 9 players against 11. I think that's one of the reasons why we got smashed so hard. The final score was 3-0. Not too happy about the result. I still like the Sounders. I'm not a bandwagon fan. But the reason why I am wearing the Korea jersey is because we just played against Iraq, and it was an absolute dominating performance from beginning to end. Like, my goodness, that Korea team looked so good. And don't dismiss Iraq. Their football team is actually really good because they beat Japan. I think it was like 2-1. And Japan is a pretty good team too. So pretty happy about Korea. And one of these days, I really do got to get a USA jersey because I do support the US men's soccer team as well. And the last thing that I wanted to talk about is if you are enjoying the content and you wanted to take it a step further and support me, why not consider the Patreon? Would you consider the Patreon? What you see on your screen right now are actually all of the Patreon members so far. I love you guys more than you know. I literally talk about you every day to my wife. So excited that it's growing and that you guys believe in me, that someone like you would choose to support someone like me. I don't take it lightly. Like, I am grateful and I appreciate you guys. And right now, I'm actually running a campaign where if we reach 15 members in the Patreon family, I'm gonna buzz my head. As you can see by my hair, I love my hair. But I'm willing to do it, and that's a promo that we are running. And right now we have 10 members. And so my wife and I, we were talking, and she was like, Amos, you are always selling yourself short. Why not go for a more pretty sounding number like 20? Why 15? And that's because I felt like I was not going to be able to hit 15 anytime soon. And I think she might be right in this regard. So I might move the sticks a little and call it like a second down and 10 yards to go. So we might push it to 20 members and then I'll buzz the head. But right now we are at 10. So we are still very far from 15 or from 20, but we are getting closer. And if you want to hear my full pitch and what's in it for you, if you choose to join the Patreon, well then watch the video that's in the pinned comment. I'll give you all the reasons and some more as to why you belong in the Patreon family. Anyways, that concludes the video. I love you guys. Stay safe. Good luck in the stock market, and I will talk to you next time. Peace.